Take a moment and slow down for a second, because what we are watching in the metals market right now is not a breakout. It is a pause before a decision. As of this moment, gold is trading around $5,208 per ounce. Silver is hovering close to $88. Those numbers are important, but they are not the headline. The real story is that the market has entered what I would call a waiting moment. Not a collapse, not an explosion, a moment of observation. Because within days, the United States will release two pieces of data that the entire financial system is watching: CPI inflation and the PCE index, the very measure the Federal Reserve follows most closely when deciding monetary policy. And that leads to the question quietly shaping 2026. Is the Fed preparing to ease policy, or will rates remain restrictive longer than investors expect? Institutions from hedge funds to central banks are recalibrating portfolios around that answer. Markets often move before headlines, but sometimes they simply wait, watching the same numbers, the same signals, the same policy path. And when gold holds above $5,200 during a moment of hesitation rather than panic, it tells us something subtle about the psychology of capital. Because sometimes the most important moves in markets begin during the quiet moments when nothing seems to happen. Now here is where the story becomes more interesting. Because something unusual is happening beneath the surface of the market. Normally, when oil prices fall, inflation fears begin to cool, and gold tends to lose some of its urgency. And recently, we've seen exactly that kind of signal emerging. Brent crude has been drifting back below the $90 per barrel level, partly because traders are pricing in the possibility that tensions with Iran may de-escalate, and partly because reports suggest the International Energy Agency, IEA, could coordinate one of the largest strategic petroleum reserve releases in history. In a textbook model, that combination should calm inflation expectations ahead of the upcoming CPI and PCE data. The two indicators the Federal Reserve is watching most closely. But here's the paradox. Gold is still holding firm above 5,200 berts per ounce. That detail matters more than it appears, because it tells us the market is not only reacting to inflation anymore, it is reacting to something deeper. Systemic uncertainty. Investors are watching the Middle East, the security of the Strait of Hormuz, and the fragile balance of global growth. And when capital continues flowing into gold, even as inflation signals soften, it suggests that what markets are really pricing now is not just rising prices, but rising risk. And once risk becomes the dominant narrative, the behavior of capital can begin to change in ways that few people expect. But now let's shift our attention to silver for a moment, because its behavior right now is telling a slightly different story. As of today, silver is hovering near $88 per ounce, slipping about 0.1% in recent trading. At first glance, that may look like weakness, but in reality, it is something much more familiar to anyone who understands how this metal moves through economic cycles. Silver has always lived a double life. On one side, it behaves like gold, a precious metal that investors turn to when uncertainty rises. But on the other side, it is deeply tied to the machinery of the global economy. It is used in solar panels, in advanced electronics, in electric vehicles, and even in components inside the expanding network of AI data centers. And when markets begin to question the pace of global growth, silver often pauses before gold does. That doesn't necessarily mean the long-term trend is broken. It simply means the market is recalibrating expectations about industrial demand. In other words, silver sometimes reflects the heartbeat of the real economy, while gold reflects the psychology of capital. And when those two metals briefly move at different speeds, what you are really watching is the global system trying to decide whether the next chapter will be driven more by growth or by fear. Now this brings us to the real pivot point in the story, because when you step back and look at the broader landscape, one institution is quietly sitting at the center of it all. The Federal Reserve, according to the latest probabilities from the CME FedWatch tool, the majority of investors currently expect the Fed to hold interest rates steady at the March 18th meeting. On the surface, that may sound uneventful. No dramatic rate cuts, no sudden tightening shock. But markets rarely move based only on what happens today. They move based on what investors believe will happen next. And that subtle difference is exactly why gold remains comfortably above $5,200 per ounce. Despite the uncertainty around inflation data like CPI and the Fed's preferred gauge, PCE, by keeping policy steady for now, the Fed is effectively buying time for the market to stabilize around elevated asset prices. Yet the real question isn't whether rates stay unchanged this month. The real question is when the conversation about rate cuts truly begins. Because historically, once the Federal Reserve signals a shift toward easing, capital tends to migrate quickly into hard assets. Gold, silver, and other stores of value. These often become the first places global liquidity looks for protection. And if that shift in policy rhetoric starts appearing in the months ahead, the quiet stability we see today could quickly transform into something far more dynamic, which is exactly where the next layer of this story begins. But if you really want to understand what the market is trying to say right now, you have to step back and look at all the moving pieces together. Because none of these signals exist in isolation. Gold is holding above $5,200 per ounce. Silver is consolidating near $88. At the same time, the world is watching tensions far beyond commodity charts. The situation in the Middle East, the fragile stability of the Strait of Hormuz, and the shifting expectations around Federal Reserve policy. Energy prices are fluctuating. Inflation data from CPI and PCE remains uncertain. And global investors are recalibrating risk across currencies, bonds, and commodities. On the surface, markets may appear quiet, but beneath that calm, something deeper is taking shape. Gold rising more than 20% since the beginning of the year did not happen because of a single headline. It reflects a broader adjustment to a new financial cycle. A cycle where geopolitics, energy, and monetary policy are becoming tightly connected. In other words, the metals market is not just reacting to news, it is interpreting the direction of the entire system. And when markets begin processing the world that way, the next moves rarely come from one event alone. But to really appreciate the significance of what's happening now, it helps to step outside the present moment and glance briefly at history. Because markets rarely move in completely new ways. They often echo patterns we have seen before. One of the clearest examples is the cycle between 1970 and 1980. During that decade, the global economy was shaken by the 1973 OPEC oil crisis. Inflation surged across the United States, and the monetary shock followed President Richard Nixon's decision in 1971 to end the dollar's convertibility to gold. The world suddenly had to adapt to a new financial architecture. Energy prices surged, confidence in currencies wavered, and geopolitical tensions in the Middle East became part of market psychology. The result was extraordinary. Gold climbed from roughly $35 per ounce to nearly $850, an increase of more than 2,300% in less than 10 years. Today, investors are looking at a similar environment. Energy uncertainty around the Strait of Hormuz, inflation data from CPI and PCE shaping expectations for Federal Reserve policy, and gold already rising more than 20% this year. History never repeats perfectly. But it often rhymes. And that raises an important question. Whether we are witnessing another long-term transition quietly beginning to take shape. Now this is where the picture begins to feel strangely familiar, especially if you've studied financial history. Because when analysts compare today's environment with the 1970s cycle, the parallels are difficult to ignore. Back then, the global system was shaken by the OPEC oil shock. Persistent inflation spread across the United States. And the monetary system was still adjusting after the Nixon shock of 1971 removed the dollar's link to gold. Energy supply became uncertain. Currencies were questioned, and geopolitical tension in the Middle East shaped market psychology for years. Now fast forward to today, and the pattern begins to echo. Instead of the oil embargo of the 1970s, markets are watching the fragile security of the Strait of Hormuz, one of the world's most critical energy choke points. Instead of runaway inflation alone, investors are studying incoming CPI and PCE data, trying to determine how the Federal Reserve will navigate the next phase of monetary policy. And instead of gold fixed at $35, we now see it holding above $5,200 per ounce, already rising more than 20% this year. The details are different, but the structure of the story feels familiar. Energy uncertainty, monetary transition, and investors quietly searching for stability. History rarely repeats exactly, but it often moves in recognizable rhythms, And when markets begin to rhyme with previous cycles, it raises a deeper question: whether we are witnessing the early stages of another long-term shift in the global financial landscape. But when you bring all of these signals together, something larger begins to emerge beneath the surface of the charts. Gold is holding above $5,200 per ounce. Silver is stabilizing near $88. Energy markets are fluctuating around $90 per barrel. And investors are waiting for CPI and PCE inflation data ahead of the next Federal Reserve meeting. None of these developments exist in isolation. They are fragments of a much bigger transition across the global financial system. Markets often move quietly before the broader public recognizes that a cycle is changing. Gold has already climbed more than 20% since the beginning of the year, and that move is not simply the reaction to one headline or one policy decision. It reflects a gradual shift in how capital is interpreting the world. Rising geopolitical tension in the Middle East, uncertainty around energy security through the Strait of Hormuz, and the possibility that the next phase of Federal Reserve policy may eventually involve monetary easing. When investors begin connecting those pieces, precious metals stop behaving like ordinary commodities. They begin behaving like strategic assets again. And that is why this moment feels less like a single market event, and more like the opening chapter of a new financial cycle. Because sometimes the most important changes in markets do not begin with an explosion. They begin with a quiet realization spreading slowly through global capital.